Welcome to Mustang Deep Dive. Today I'm breaking down QQQI. That stands for the NEOS Nasdaq 100 High Income ETF. This unique ETF seeks to give investors both regular income and exposure to the Nasdaq 100 index. It does this by combining stock holdings with an active call option strategy. Let's unpack how it works, how much it pays, the risks involved, and whether it might work for your portfolio. What is QQQI? QQQI is an ETF that invests in the largest non-financial stocks listed on the Nasdaq. These include companies like Apple, Microsoft, Nvidia, and Amazon. On top of owning these stocks, the fund uses a call option overlay. This means it sells the right for someone else to buy those stocks at a preset price in the future. Doing this generates extra income, but also limits the upside if those stocks rally strongly. How QQQI generates income. The fund earns dividends from the Nasdaq stocks it owns. Then it sells monthly call options tied to the Nasdaq 100. Those options bring in premiums which are passed along to investors. Once per month, investors receive a cash distribution from this combined income. This method aims to balance market exposure with regular payout, recent yield, and tax efficiency. QQQI offers a relatively high monthly income stream. The listed annual income rate is over 14% of your investment. More importantly, it uses Section 6020 option tax treatment and may harvest tax losses to boost net return. This makes it more efficient than many typical dividend funds' fund performance. Since its launch in the first month of 2024, QQQI has attracted a lot of assets. The fund has grown to several billion under management and was recently named Best New Active ETF, including its monthly income. The yearly total return has been around 15%. When compared to the vanilla Nasdaq 100 index return, it is slightly behind, but the monthly cash makes up the gap. Price and NAV stability. QQQI trades very close to its net asset value. That means you can buy or sell the fund without paying much over or under the actual value of its holdings income tracker. Investors receive one monthly distribution. That distribution rate varies but has consistently supported a healthy income stream. The fund aims to pay each month regardless of market swings. Risks to know. First, this fund caps its price gains when the Nasdaq 100 rallies. That means if tech stocks rally sharply, QQQI will lag behind. Second, the fund uses options which can add complexity and exposure to price swings. Third, the higher income often includes return of capital that can reduce the fund's value over time. Lastly, the tax treatment can be complicated and may require attention at tax time expense ratio and structural cost. The fund charges a moderate fee of just under 0.7%. That covers fund expenses, including the active option overlay. This cost is higher than passive index funds, but typical for an active income ETF. How it compares to peers. QQQI is often compared to Roundhill's zero-day options ETF, which also sells calls weekly. That fund is slightly riskier with higher volatility and lower risk-adjusted returns. QQQI offers steadier monthly income and lower volatility. Who QQQI is for. QQQI suits investors